Many people are scared of high taxes in the USA. And indeed, they're not small, but there are ways you can legally avoid paying taxes, and in this video, we will discuss these methods. These methods are used by wealthy individuals such as Elon Musk, Jeff Bezos, and Donald Trump to increase their capital, and you can do the same. First, let's understand the concept of tax-free income. There are certain categories of income that are exempt from taxation. This does exist in the United States. What is it? The U.S. tax code states that any income that is not an exception is taxable income. So, you need to know the exceptions. There are different exceptions. Let's see what they are and how you can use them. The first one is interest on municipal and state bonds. This means that if we invest in and put money into these bonds, we can avoid paying taxes on the interest. The next point is gifts. If we receive gifts, they're not subject to tax, even if it's a cash gift. So if we receive a gift of $100,000, it is not subject to tax. The recipient of the gift does not pay anything. Gift tax is paid only by the person giving the gifts and only above a certain amount, which is called gift tax exclusion. The 2024 annual gift tax exclusion is $18,000 per year, up from $17,000 in 2023. So if I am a philanthropist and a wealthy person, I want to give you $18,000. Neither me nor you have to pay tax. In case of giving $19,000, I would only pay tax on $1,000. You, as a recipient of a gift, don't pay tax at all. And this amount is determined per family member. For example, if I decide to give a gift to a family of 4, I can write 4 checks totaling $72,000 and no one pays tax. The third option is money received for child support and alimony. Usually, this is from one of the separated parents. Also, government programs such as food stamps, rent assistance, WIC, and some free medical insurances for low-income families are not taxable. Any, even minimal assistance in emergencies or disasters is not subject to tax. So the fourth option is the amount up to $5,250 paid by the employer for education is not subject to tax. For example, if you want to go study and you will need to pay this amount for education, instead of paying it after salary deductions, after paying Social Security and income taxes, it's better to ask the employer to pay directly for education so that you don't pay taxes on it. There are also small benefits known as de minimis fringe benefits from the employer. These are small benefits that are difficult to track and calculate. Examples include event tickets, subscriptions to services, small holiday gifts, food provided in the office. So, if there are expenses they still need to incur, why not negotiate them with the employer to provide them through the de minimis fringe benefits? The fifth option is the Social Security pension. In most cases, Social Security pension is not taxable. Also, pensions received from other countries are not subject to tax. The sixth option, if you sell your home where you live for the past 2 out of 5 years, the profit up to $250,000 is not subject to tax. If you're a married couple, this is $500,000 not subject to tax. For example, you and your spouse bought a house for $250,000, lived in it for 2 years, and sold it for $750,000. Imagine having $750,000 in your bank and paying 0 taxes on it. Seventh option is withdrawing funds from a Roth IRA account. Investments in a Roth IRA account are not subject to tax deductions, so withdrawing funds from a Roth IRA account is also not subject to tax. For example, if over the past years we have been contributing money to this account and today we need to buy a house and want to use this money for a down payment, withdrawing money from Roth IRA account will not trigger any tax. That is the biggest advantage of this account. Often, life insurance payouts are not subject to tax. However, there are some exceptions, but in most cases, they're not taxable. Also, compensation payments for workplace injuries or workers' comp proceeds are not subject to tax. Many people do not understand this aspect of employment and often ask me, what's better or more profitable, to work as an employee on a W-2 wages or consider being a subcontractor or self-employed individuals or 1099 NAC recipient? Here's the difference in this case. If you are an employee receiving a paycheck, If any injury happens in the workplace, the employer's insurance covers the incident. In certain cases, compensation for workplace injuries can be quite large, amounting to tens or hundreds of thousands of dollars, and these compensations are not subject to tax. And compare the same scenario if workplace injury occurred and you are self-employed, unless you got a specific coverage for yourself. I highly doubt it. Then, there is practically no chance to recover any compensation. You are on your own. Considering this factor, I recommend covering yourself by being an employee, especially if your trade is very risky and a high chance of work-related injury. Okay, these exceptions rarely happen, but it's always good to know about them. Trust me. Now, let's consider we do have taxable income, as all of us do every year, and every year we have to pay taxes on our hard-earned money. What do we do to lower our taxes and bring it to zero? Let's look at investments in retirement accounts that are not subject to taxes. By investing in traditional IRA, 401k plan, or SEP IRA retirement accounts, you can reduce your taxable income. What is a traditional IRA then? If the employer doesn't offer us a plan and the amount invested in the traditional IRA reduces our taxable income, the same happens with SEP IRA. This is in addition to our standard deduction. That is, the amount of income minus standard deduction minus the amount we invest in the retirement accounts. So it may happen that our taxable income will be either very small or zero. I highly recommend maximizing your paycheck deductions. The most popular ones are 401k plan, which comes with the tax deductions, and health insurance also comes with the deductions before taxes. Also, accounts like HSA or FSA. These are health savings accounts and flexible spending accounts for medical expenses, not insurance, but mainly small expenses, deductibles, copays. These are some small medications and doctor copays. If you need to spend on glasses or lenses, so you need to buy medication at the pharmacy, instead of spending money from your paycheck, from which you already pay taxes, a separate account is provided where you can deposit money before taxes and use them. In case of HSA, there is no limit on using this money. With FSA, you have a year to use this money. If you haven't used it for medical expenses during the year, this amount could expire. So planning is required here. How much will be needed in the future? Various transit passes or transit deductions are also popular methods. This includes public transportation costs, commuting to work, parking your car, or even parking a bicycle. All of this can be included as the deductions before taxes. If you have small children under 13 years old, dependent care benefits, which cover child care, summer camps, extended care, can also be deducted from your pay before taxes. This also includes if you have dependent disabled individuals or parents who need caregiving. All of this can be planned through deductions via the company, and all of these expenses can be paid before tax deductions. Let's see how it works. For example, you have $1,000 weekly salary. In the standard scenario, you pay Social Security taxes, federal taxes, state and local taxes from the $1,000. And let's imagine now you have $200 worth of pre-tax deductions, $100 401k plan and $100 HSA account, let's say. So with these pre-tax deductions, now my taxable salary is $800, from which all the taxes will be calculated. Now imagine the tax savings for the entire year. If you want me to analyze your individual situation on how to minimize your taxes, schedule an online consultation. The link is in the description. Another way not to pay taxes is through long-term investments. If you're single and your income from long-term investments is up to $44,000, $625,000 per year, the tax is zero. The next bracket, which is 15%, if your income from investment is up to $492,000 per year. A fairly large range. Everything above that is 20%. If we are a married couple and income from investments is $89,250, then tax is zero. Long-term investments are not only stocks, but also can be proceeds from property sale or rental income. So, if the income is up to $89,250 per year, it is not subject to tax. Another very important point is to know the deductions available for you. Every year tax code changes, and there are certain deductions in one year, and another year they're gone. There are also certain income thresholds, statuses. All these details I recommend starting to understand, study, and know them in advance prior to tax filing. For example, there are education credits, dependent care credits. Currently, residential energy savings credit or vehicles that help us use natural resources efficiently are very popular. If you qualify for it based on your income for the entire year, then you can make the purchase. If you're already limited in income for this year, plan it for next year if possible. Also, know the limits. Know how much you need to spend in order to make that deduction. A broad example is education credit, dependent care credit. If a child or you are pursuing an associate or bachelor degree, the limit is $4,000 per year. So, if you have already paid $4,000 in this calendar year, plan the next sum for the following year if possible, or vice versa. If you already have a shortfall, you need to make a prepayment for the next month. You can do it today. Why? Because the tax code allows us to use the expenses when they are actually paid. The same goes for dependent care credit for child or dependent care expenses. The limit is $3,000 per year. If you already have it, you can wait and transfer some amount for the subsequent year. Likewise, with home energy efficiency credit. If you need to replace the roof, doors, windows in your home, it will save you energy and also give you a tax deduction. So, you need to know what deductions you're entitled to, how much income you should have, and plan them correctly for the year. An important aspect is to maximize itemized deductions. What does it mean? The government gives us an option to use whatever is larger, standard or itemized. Itemized deduction is mainly claimed by homeowners because when you own a home, most likely you have mortgage interest, real estate taxes, which usually will be a bigger number than government-provided standard deduction, or state taxes deducted from an employee. Or many don't know it. It includes a sales tax on everything. It could be any purchases in day-to-day life. I often encounter situations, especially in the first year of buying a home. And the first year of buying a home, we start buying many things for the new home, such as furniture, household items, and all of these sales taxes can also be deducted in itemized deduction. The last way not to pay taxes is to start your own business. If you have long been thinking about opening your own business, it is probably the time to start one. United States has the most favorable conditions for starting a business. At the beginning, it is not necessary to open something specific like LLC or corporation. You can even start and run a business as a sole proprietor. This way, you can get additional deductions such as home office, a car, if you use it for work or business. Also, small things like a computer, internet, phones, and so on. Or if you need to buy something for your business, you can purchase all of these things and you can deduct them from your self-employment income. If you're planning to start a business, watch this video to avoid the common mistakes that beginner entrepreneurs often make.